Okay, so we're going to start off with gold here. And Alex, you asked me now, said that you saw that there was a gap. I'm assuming that you are referring to this gap over here. Is that correct?
Correct.
So you want to know if gold bias is bullish or bearish, I'm assuming, or what do you want to know specifically?
Yes, I want to know is if you have this gap, for example, and they are consolidating for this long time, my guess is probably they are going to go down, fill the gap before they keep continuing, as gold is in a pretty bullish situation right now.
Yeah, definitely. So as we can see on the higher time frames, it's just annihilated all the highs and just continuously uh, decided to be and stay bullish for a very long time. And the reason why gold came up to these highs over here is that there was these triple top formation over here, if you want to call it that, as a retail trader. But we call this equal highs, and we know that with equal highs, liquidity sits at this point over here. So this is why gold targeted this specific area over here. And if we pull this to the right over here, you can see that gold has taken out that liquidity at that equal highs section. So when we see equal highs like this is like a magnet for price to take out because there is liquidity in the form of buy stops or sellers that had sold long ago at 2012, 2011 actually. So they have their stop losses sitting here and they would be likely to have less liquidity than people that trade breakouts and have their buy stops sitting over here. So when price comes above these areas, we can see that when price came there, it wicked in and then went against the price. So if we go here, now it is consolidating over here. But when it wicked through, it dropped. And the reason it did that is this large move over here. Generally, traders, retail traders also, will not hold gold with a 200 pip stop loss. So 200 pips for gold is quite large. So if they had a buy stop at this red line over here where we had our equal highs, they would have been taken in, but they would not have held on to their trade. And that is a correction on gold. And price then retraced into this order block as we see over here. So this order block is still being respected over here. So as Alex said, that gold is very bullish and it remains bullish because multiple time frames to us confirm that it is bullish. And we can see that this order block over here, when this was the last bullish order block before this strong move to the upside, and even though price wicked through here, it did not close below this order block. So if we zoom in here onto gold, we can actually see that 50% of this fair value gap when it was created, so they used some of this fair value gap when they retraced price down, and when price retraced further down, they used about 50%. So we can actually measure that if we take our fibs over here, and we can see that this line here represents equilibrium, which is our 50% of that fair value gap right there. So to the pip, they take 50% and then they rally gold back up. So the entire time that gold has been trading inside of this range, it may look like nothing is happening, but they are essentially engineering liquidity with this move down, with this move up, with this move down, with this move up. And this is very easy to see that if we go down to a 1 hour chart, we can see here that I have what we call yesterday's high and yesterday's low. So essentially what they are doing, they are engineering liquidity. So if we zoom in here to this whole of these last 2 weeks, on gold, when price rallied up from gold, so this red box over here would represent the last 4-hour bullish order block to take gold, thrust it up into the 1.18 region, and when price came down and traveled sideways over here, it was generating liquidity. Okay, so when price formed this low over here, we can see that that was the lowest point of the 9th of July right here. So that is what we know as a point of liquidity. So there is sell stops sitting over here, and there is people who buy over here and place their stop loss below this recent low. So what happens? They will engineer liquidity, drive price away over here, and if you notice that this is a perfect retail setup over here on gold, where they make a double bottom, and retail traders see that as support, so they place their stop losses below this point of liquidity, increasing the amount of liquidity sitting at gold over here. Okay, and at the same time, it is also making highs that have not been raided over here. So these highs also contain points of liquidity. So these lines would represent the points of liquidity for recent highs where either buy stops or retail traders who have sold place their stop loss at these levels. So there is liquidity sitting above these levels over here. Okay, and essentially what the market makers will do, the banks, the institutions, or whoever you want to call them, will engineer liquidity and allow retail traders to get some pips, but at the same time, they will take them out. So when this double bottom here for retail was formed, this is equal lows. So this is a point of liquidity. And this point of liquidity, when it is created, it makes a high over here. And when price comes back down, it clears these lows over here. Like I said, that is a point of liquidity, a magnet for price. So they raid this liquidity pool over here, and then they rally price back up. When they rally price back up, what do? They take out the high of the previous day sitting over here. So this is also a point of liquidity, and that gets raided with this wick of this candle, and then price goes down again. So now we see that when this low was formed over here, an additional point of liquidity is sitting now for the buy or for the sell stops. The stop losses, liquidity pool sitting over here. Price rallies, takes out the previous day's high, runs out this liquidity pool over here. Price pushes back up, raids the liquidity there, pushes price back down. And as we can see, when price gets pushed back down to this low over here, this low gets taken because there is liquidity sitting over there. Okay, and now we see price rally. Where does it rally to? The previous day's high. Well, not the previous day, it was 2 days prior high, which is this liquidity sitting over here. So that liquidity above this high for retail traders is where they would have their stop losses, their buy stops. Price raids that area and runs price down. When it runs price down, the traders, the retail traders who have bought because this is a breakout to them, will hit their stop loss because they will generally not hold on to gold for 120 pips when it goes against them. So now we see price form that high, and when price comes back down, it has a reason for price to come back down over here. As we can see that this is a fair value gap over here. So there is a reason for price to come in over here. It closed this fair value gap over here and price rallied. Now it did not take out the liquidity sitting above this high over here. Okay, so when that happened, we had additional engineering of liquidity created over here at this high. And when price came down, bounced off the fair value gap over here, we could essentially say that those are equal highs because their highs are almost equal. So that becomes a larger liquidity pool than just one high sitting over there. And if we zoom out over here, we can also see that price has not come and taken, besides this low over here, that was the previous day's low, as we can see. So liquidity sitting there gets raided, and price has not taken out this low of the 14th of July, and price has rallied. Now, the reason price is rallying on gold is because there is a large pool of liquidity of sellers and breakout traders. So you can think of it like this. These equal highs we have sitting over here. If we bring these highs across over here, this is a magnet for price. It is attracted to these areas, as well as these highs over here and these highs over here. So now we have essentially 1, 2, 3, 4 highs with a large amount of liquidity sitting at the top here. So price is being drawn to that area over here. And that is why we are seeing this large rally of gold of 150 pips on Thursday and Friday. So end of night on Thursday into Friday morning, the London Open, price continuously rallied, and it is being drawn to these equal highs. So while we know that the price on gold is bullish, confirmed by the high time frames on the weekly, as we said that those highs had been raided over here, we also have ourselves an order block. Now, this order block still is valid on the weekly chart because it has not been traded through. So there will be orders sitting in here that are for the sells. But what essentially can happen is when we see accumulation in a range like this, the orders that the banks, the institutions have are being exchanged. So if, for instance, the banks had a large amount of price that they were selling at, they will exchange that and want to take price higher. And this consolidation or compression or accumulation, whatever terminology you want to use, this is what we see here. So we can have two scenarios where we have, let me just clear all of this stuff up over here. So like I said, we have two scenarios here where we can take out the liquidity at the top, and when this liquidity at the top with all of those equal highs get raided over here, we could see a move to the downside when we have this gap sitting over here that Alex pointed out. So I do see gold continuing to press up these highs. May not take all of these highs, but there's at least 2 to 3 highs it will raid, and then potentially we can look for a drop in gold if you want to sell. If you want to buy gold, you would look for a setup where price would push up, and as we know, the order blocks are being exchanged. So there is a large amount of abundance of selling pressure because we have bearish order blocks here. We have a bearish order block on the weekly. But like I said, that if we have accumulation, compression, and consolidation, the banks and the institutions can exchange their orders that they have for selling in exchange for a buy. And when we know that retail thinks of it as the perspective of resistance becomes support, if you will, well, then this is a very likely scenario. But I would say that they would raid the highs first and then bring price down. So this scenario where they take price up and it bounces off, I find that very unlikely to happen because gold has already rallied up and there's more liquidity right now sitting below, not to mention that at this point over here, there is a large imbalance of price. So we can see that there is only wicks there and there is no bodies of any candle. So that is a large imbalance of price sitting between the 740 and the 750 price level. So we could even see a large move to the downside for gold. And if this fair value gap is not enough for them, when they bring price back up over here, there could potentially be a larger move waiting for us to come and balance price before we then go bullish again. So that is my take on gold. I don't see that this would happen where they break out and continue to go higher. I would think they would raid the liquidity first and then bring price back down to fill this fair value gap. We would then see further reaction at this fair value gap, and we would have to decide once this fair value gap is closed what sort of price action is occurring here, because we can see that this is also a 4-hour order block on gold over here. So that would give us a reason to trade back up. So we also have then bearish order blocks formed if price drops. So we'll have a bearish order block on gold to push price up from this zone, but we will also have bearish order blocks sitting at the top over here. So that is why I say liquidity is sitting there. It gets raided, comes and tests this fair value gap sitting over here. We'll see possibly a little reaction off over here before we could see a break of this order block. So this order block might even be the one to push price completely back up, but we would have to wait for that price action to occur. Essentially, at some point, this fair value gap or imbalance of price rather should be filled because it is recent. It's not very long ago that this imbalance of price was created. So if we look at the daily, we can see that this imbalance of price over here is actually quite large on the daily chart sitting over here. And we also have a order block that is daily order block sitting over here. So this is a large daily order block. So we could even see another wick down into this imbalance and then price go off because we have a lot of buy pressure with all of these order blocks that have been created. So to take price of gold down would be harder than it would be to push on the price up. Alex?
Yes.
You were listening, not sleeping?
Yes, it's very clear. No, I was listening.
Okay, so
Thank you very much.
you asked about IPLs for gold, and gold, I've
Yes.
said before, is it is a tangible physical substance we can touch, and the majority of gold is not held by a bank like a currency. Currencies for banks are held by banks. You don't see your currency that you own, you see it in your bank account. You don't physically touch the money you own. Well, maybe you do, maybe you've withdrawn all your money. But generally speaking, everyone's money is in their bank account. It just represents digits. It's not tangible really, unless you go and withdraw money. So the money is there, whereas opposed to gold, gold is physical, it's tangible, it's held in a vault. So ownership of gold is different to ownership of currency. And having said that, the IPL for gold is less applicable. So don't worry too much about an IPL on gold. But if you were to know that our values for IPL is a 0 level, it is a 2 level, it is a 5 level, it is a 8 level, okay? And that can be the same as whether there is decimals or whatever oil you're trading or whatever the case is. The numbers of the zeros, the numbers of the twos, the numbers of the fives, the numbers of the eights represent key institutional price level of whatever we look at. So this can be in the thousands or decimals of, or the 200s or the 10,000s, as long as it's got 258 or 20, 50, 80 or 200, 500, 800 or 0 or 00 or 000, or can even be 2,000, 5,000, 8,000. You see where I'm going with this? These numbers represent institutional price level. So particularly, for instance, a currency goes to, for example, 258 or a 140.258. That number represents significance because, sure, it is a 200 IPL, but so is a 5 and so is a 8. So sometimes you will see price to the wick goes 258 or 528 or 825. And there's reasoning behind that is because those numbers represent institutional pricing levels. So for gold, it would be the same where the 0, the 5, the 2, the 8, the 2,000, the 5,000, 8,000, and everything in between would be important. And obviously we know on gold that we have a decimal. So 0.80, 0.50, 0.20, 00 levels would all represent IPL. But like I say, gold is less effective on IPL.
Hello.
Hello.
Hello, Darwin. Good evening.
Hello.
Hello, Darwin. This is Charles.
Yes, Charles.
I would like to ask a question. What's the meaning of IPL?
IPL is institutional price level. This is a video
Okay.
uploaded in my YouTube channel, so you can go
Okay.
and look.
Okay. I've watched it. I have a second question to ask.
Yeah, sure.
Okay. It seems as if price needs to balance before it takes another movement, either to the up or to the downside. I think that is one beautiful thing about this institutional price strategy. Price needs to balance before a movement to the up or downside, just as what you.
Yes, of course. So not always. So there can be imbalance, but generally balance does balance itself out when there's large imbalance. So when there is large imbalance over here, we're looking at EU, for example, you can see that these two bearish candles had large imbalance in price over here. So there was a
Okay.
large imbalance over there, and there was a large imbalance over here. Now, a lot of people will just sell Euro USD thinking, okay, it's bearish now. Sure, it may be bearish, but this imbalance or liquidity void that sits here is very likely to at least fill 50% before there's a further move to the downside. And as you can see, this imbalance was filled. So if we look at the same now on the right-hand side, when price rallied up, we have an additional imbalance of price. So price will fill this balance over here and then decide to either go up or continue its
To
downward.
the downward side.
So like you say, price likes to balance, especially on major pairs. Their imbalance of price is rather effective if you like to trade liquidity voids or fair value gaps. Price likes to be balanced, especially on the major pairs. And even if you trade pretty much any other pair, you will notice that price likes to balance itself. Sure, we just looked at gold over here, and there were some imbalances. But generally, if we look at a lower time frame, when price rallies, you see these small retracements back, and these wicks fill these imbalances of price. So when price rallies, we can see a pullback, and then price continues back down
To
again.
the upside.
When it rallies up, it closes that imbalance of price.
Balance.
So sure, there is imbalances left along the way, and these imbalances will be filled at some point, whether it takes 2 weeks, 1 week, 1 day, 1 year, it will eventually be balanced. So it's just
Okay.
a confirmation to us for the reason for price to target that area, or
Okay.
price that is a very bullish or very bearish, price will again come into that zone. So
Okay.
it can be used to either sell from or buy to.
Buy to.
So
Okay.
so when you have example over here, let's just clean this chart up. So if I zoom in here on the 1 hour chart, we have this order block sitting over here. So when this order block is created, there is a large move to the downside over here below it, okay? And this creates imbalance of price, okay? So now we have an imbalance. So now we have a bearish order block. So we know that the banks have a grouping of orders sitting over here that pushed price lower. And in doing so, because every buyer needs a seller and every seller needs a buyer. So we know that there was a large amount of selling pressure here. Price became imbalanced. So price will like to balance itself. And what happens? Price pushes through over here, rallies back up to close this fair value gap, tests this order block over here, and then price pushes back down. So when we see an order block, when we see a fair value gap, that is good sign to us that the institutional flowing of orders is in the direction we see it. So in this particular scenario, we see a bearish order block, we see a liquidity void on the lower time frames, but on the 1 hour, it is only a fair value gap. So we know that when price comes back there, we can look to sell again because of the same reason. And here is a reversal example. So here we have a 1 hour bullish order block sitting over here. So when price thrusted away or rallied away from this area, we have a fair value gap sitting over here. So when price rallied away from this order block over here, it rallied into this high over here. And when it retraced, we pull this fair value gap across over here. It balanced, and there was an order block sitting over here. And we can see how price bounced off this area. So it bounced, created a fair value gap, 1 hour order block that's bullish. Price rallied into this high, came back lower, closed this fair value gap, bounced off of this 1 hour order block, and then price fell at the top where this order block was created. So day in, day out, these moves happen. You just need to train your eye to see what happens at these areas over here. Charles, does that answer your question? Are you happy? You should rather also go and watch the other.
Yeah, I really appreciate.
You should also watch the other YouTubes I created. It covers all of everything we do on the Zooms in great detail. Does anyone else have a question?
Yeah. The video on YouTube has been
Yes.
helpful. Thank you.
Yeah. If you're on the Telegram group, we can just post it for you and you can go and visit those links.
Okay. Thanks, Darren.
Podgy, you have a question. Your hand's up. Your mic is muted.
Hello, Darren.
Yes.
Sorry, this is Charles. Can the fib setting be used here? Can we use the Fibonacci
Yeah, of course.
certain year?
Yes, of course you can. You can use Fibonacci anytime you want. A lot of people like to trade it on by itself without any other confirmations. I don't do that personally. I like to use it as an additional confirmation to take a trade. There are some scenarios where you can trade it on its own, but you would need to train your eye to know how to use the fibs and the fib settings we use. And if you go again and watch my YouTubes, that information is all available on the YouTubes with everything that we cover in these videos, like I said. So I would recommend you watch those videos. They are the essentials for everything we conduct on the Zooms.
I've watched the YouTube video, and it was wonderful because the fib setting has been helpful. I made a lot of profit
Yes,
this week using the
just
fib
just
setting.
that just that alone, like I say, you can trade it on its own. And the fibs we use are institutional levels for premium and discount levels. So when it
And
retraces
that's what
to that specific zone, that is why you want to sell or buy at the zone, because that is where banks would look to buy or sell at those zones.
or buy or sell. That's the premium and the discount. I tried them and it has been helpful throughout this week. I've been making a lot of profit from it.
That's good. That's good. I'm glad to hear.
Yeah, thank you very much, sir.
Anyone else got a question? PODG,
Yes,
you've got a question.
Mr. Darren.
Yes, hello.
Yes. What kind of reactions do you have when before a breaker happens when you're at the source?
Sorry, your mic is breaking up. Can you just repeat that question?
I'm asking
Hello?
that
Sorry, I cannot hear what you're saying. Maybe if you can type your question. I cannot hear you. Your mic is breaking.
before a breaker, before there is a breaker,
Can you guys hear me?
Hello, Darren. Hello, Darren.
Yes, hello.
Hello. My question is, how do I determine my bias on the 8-4 and daily time frames? And also, when I have my bias, how can I implement it to trade intraday on the lower time frames?
Okay. Have you watched one of my YouTube videos where I cover the order flow?
Yes. I did, but then in real time, it is a bit different to me.
Okay, no problem.
In real time.
We can cover that. So in that video, I explain that when we are following the order flow, right? So if we follow the order flow here on, for example, GU over here, okay? So starting at the bottom over here, we have an order block. Price then rallies up and creates an additional order block over here. So these two black candles are completely traded through. So that forms ourselves a additional order block over here. So sure, when price rallies up over here, it is in consolidation over here. There has been no further test of any order blocks. And when price rallies up over here, this order block over here is formed. Okay. So when that order block is formed, it then takes out this market structure over here. Price then rallies back up, and when it retraces, it tests this order block, as we can see over here. and when price rallies back up over here, there's the last bullish order block responsible for this move to the upside. Okay, so when we look at the order flow, we are looking for a candle that is in the opposite direction to tell us that the trend can potentially change. Okay, so if we look over here, that this order block over here was the last candle. You can see, depends on what color you use on your chart. So the last bearish candle before the last move to the upside. So this candle over here, this black candle, is the highest candle with the highest wick. So this becomes the source candle, okay? And there is no higher high than this. So we say that this is what we call the PFH, which is the peak formation high. Okay, so when this peak formation high and this order block over here is the last order block before the move to the upside. Okay, so if price comes and tests this order block, because it has not been tested, we expect a bounce. Okay, and that is what we got over here. So even though this wick came and closed below our order block, it is just a wick. We are looking for body closes. Okay, so as a hypothetical situation, a pretend situation, we would say that if this candle closed below this order block over here, okay, if it closed, we would say that the order flow has changed from bullish to bearish, okay? Because this order block was not respected, and this would have become our breaker if price were to close below our order block over here. So you can see that price is not closed below our order block in this particular scenario. So price is still bullish on GU. The order flow is still bullish on GU, and we haven't had an additional high set over here. Okay, so if we continue to follow the order flow over here, this would be the order block that needs to be broken now for price to come and be bearish. This is the last order block over here. So this would have been the order block, but that is no longer necessary because price has already traded into this order block. And when it did, it created itself another order block, pushing price up into our peak formation high, which is our source over here. And when price came into this order block again, it rallied from this zone over here. So until this order block is broken and price trades below this order block and price closes with a candle body below this order block, then our order flow or our directional bias changes on this particular currency pair, which is GBP/USD or GU. And once that happens, we do not sell immediately. We wait for a retest. We wait for a retest because you never just sell at market price or current market price, because that is retail trading. We wait for price to come into a zone we want to sell at. Okay, so that would be a scenario that if the order flow is changing, we want to see price come back up into either our source or potentially one of these order blocks that were created up here. So here we have an order block sitting over here, and if price comes into our order block, we expect price to bounce off of our order block. So price remains bullish overall. Okay, that does not mean that you cannot sell or buy gold or whatever you're trading in the opposite direction to the order flow. You will generally catch more pips if you are willing to hold your trade, whether it be 1 day, 2 days, 3 days, a week, 2 weeks, if you are following the order flow. But if you're trading intraday, you can essentially just trade order blocks. This trend following strategy allows you to see which general direction that GU is heading. So if you see I'm following the order flow, and you can see that on the daily, price has rallied. So it's rallied 380 pips. And if you look at a 4-hour, you can see that on a more granular level, because the order flow on the 4-hour is bullish. So the 4-hour just gives you more opportunity to make a good entry. You don't have to trade off a 4-hour. You can trade off of a 1-hour. It's not a problem. So you wanted to know, how do you know when to look for a sell or a buy? So essentially everything I've taught, whether it be fair value gaps, order blocks, IPLs, when you used a combined formula to formulate yourself an entry, you will notice large amount of trades that come your way. I wouldn't say just selling or buying just for the sake of entering a trade. Mark your charts up and you will see what we see. And when you trade the order flow and you are buying, well, generally, if you have a good entry, you can be likely to catch the most amount of pips. And one can even follow the order flow on the daily chart. So if you follow the order flow on the daily chart, the same can be said, where we have an order block which pushed price down, and when price closed above this order block, this became the breaker. So like I said, when price closes above, it creates a breaker, and that breaker will be tested. And when it tests it, you can see that it intersects with this order block sitting over here. So the yellow box, we have ourselves a breaker over here. So price rallied and closed above and came down to test our breaker. At the same time, it tested the 50% of this order block over here. So this is reason to take entry. And additional confirmation, we pull our fibs over here. And if we pull our fibs, we can see that here is additional confirmation to us as to why we would want to look for a buy. And you can see I've taught this, that this is the daily chart. So I'm pulling my fibs from wick to wick. On other time frames lower than the 4 hours, we use body to body. Okay, so we can see OTE, we have a bullish order block, we have a breaker tested. So this is a good buy setup following the order flow on a higher time frame. You need to combine everything to know what to look for. You cannot only trade off one confirmation. You should have at least 1 to 2, even 3 confirmations as a bare minimum to take a trade. Who asked that question now?
I did.
Okay, and does that help you to know that you shouldn't just trade, you should wait for price to come to you? We have all of the concepts for a reason. So when price interacts with those concepts, we can have ourselves a good trade. Let me just show you an example here of a trade I was looking at. It was USD CAD. So on USD CAD, right? So on the daily chart, let's start over here, okay? So when we look at the daily chart, we see that this is a daily bearish order block over here, and I'm going to mark this in blue over here. So this green candle, if I zoom in, this green candle over here took 1, 2 bearish candles sitting over here. These 2 bearish candles traded through this large green candle. So this is a bearish order block. And when price comes in to test this order block, we will sell. Now, if we zoom in closer here, we can also see additional confirmation over here that price is imbalanced on the daily chart. So when price is in balance, we know that balance likes to be filled. So now we have on the daily chart a bearish order block and also a imbalance of price. So now we go down to the 4-hour chart. So when this was formed, you can see the interaction of price at this zone. So if we zoom out a bit here, on the daily chart, my purple box indicates the exact fair value gap that price had opened on the daily. So this gap was created, and you can see that that gap on the daily was closed. Now, sure, there's some gap left on the 4-hour, but the daily is higher confirmation to us than a lower time frame. So there is also an order block over here. So price traded up and fell from here. So we know that this whole area for banks is a selling zone because we have evidence of that. We have this evidence here that on the daily chart there is a fair value gap. On the 4-hour, there is a large liquidity void over here. So this is a 4-hour liquidity void over here. So this is evidence to us with the large daily order block, bearish order block, that when price comes to these levels, they can sell again because their orders are here at this price, and this gives them more opportunity to sell at. So what can we do in a scenario like this? Well, we have a daily order block, bearish order block. We have a daily fair value gap. We have a 4-hour liquidity void over here. Now we add additional confirmation to ourselves. This is a 4-hour chart, so we pull from body to body. We are looking for a sell, so I'm pulling body to body. So now just by adding 3 confirmations, you can see I'm looking bearish, so I'm looking for a sell. So I pull my fibs from these bodies to the lowest bodies over here to see where price can potentially rally into. And you'll see that here is our sweet spot, which is the 62% retracement, the OTE, which is 70.5% retracement, and the 70.9% retracement. So here is our entry zone. So essentially what you can do is you wait for price to come into that zone so you can sell. Then you go and add institutional price levels. So where is the nearest institutional price level? 500. Where is the next one below that? 200. Over there. Now you start to see that not only do you have 2 reasons or confirmations or confluences to sell, you have a daily order block, you have a 4-hour liquidity void, you have a daily fair value gap, you have your fibs retracement, and you have an IPL. Now you have 5 confirmations to sell at this price level. Does that help you to formulate a trade? Whoever asked that question.
Yes, it did.
Okay, and if you're confused, definitely go and watch this recording again, because this is actually a trade that I took. So this would have been a scenario where you can look for higher to lower time frames to catch a trade. And sure, you can go trade or for 1 hour or 15 minutes, but you may only catch 20 to 40 pips if you're lucky for a day trade. If you trade with a higher time frame analysis and your entry is decent, you will have more movement generally on that trade. So you can see that this trade was 130 pips, whereas if you looked at a lower time frame, you may have only caught 50 pips of the 120. But knowing the sells from the institutions are in this daily order block with this liquidity void, more selling pressure will come at this zone over here. Hopefully that answers his question. Manana Wandile, you have a question. Wick to wick for higher time frame, body to body for lower time frame, if I'm not mistaken. Yes, that is correct. So you can see this is a 4-hour chart. So I pull my fibs from body to body, and that is why I pull fibs on a lower time frame from 4 hours all the way down to 1 minute. And if I use monthly, weekly, or daily, I will use the wicks. I will include wicks because of the reason that if we look at price data on a wick, so let's look at price data on this wick over here. This was probably news, and if we go down to a lower time frame, that area where I filled in on lower time frames has body. Okay, so there is body and data and price volume in the lower time frame. So that's why we use bodies on lower time frames, and daily and above we use the wicks because there's still volume inside those wicks. Alex, hopefully that answers your question also for the fibs. I see you asked a similar question with the fibs.
Yes, thank you.
Okay, and okay, Alex, I think I also answered without seeing your question about USD CAD.
Yes, you did. Thanks.
Okay.
Okay, excuse me, Darren.
Yeah,
I have a
Benson.
question. Yeah.
Go ahead.
Sorry, just can you go data is on 4 hour time frame?
Sorry, can you just repeat yourself?
Oh, just go back on USD card 4 hour time frame.
Yeah, sure. There we go.
Okay, okay. Can you zoom in or will I just zoom out? I don't know. I mean, there's something I wanted. No, not that, not that. Okay, fine. I'm thinking possibly. Is it possible that we are having a liquidity pool below
Being
below
created.
this
Yes.
retail support and resistance? I mean, so can we look to
Good that you
pull a
mentioned
trade?
that. That is the reason I actually sold this particularly, was if you look over here, that on this particular USD CAD, we have lows sitting here. So this is areas where retail traders will have their buys sitting. So they will have their stop losses sitting here. And if they don't have stop losses, they will have sell stops for breakout traders. So this is a liquidity pool. You are perfectly correct. We can see that there is basically equal lows sitting over here. And there's also a fair value gap sitting over here on the daily chart. So this is a fair value gap or liquidity void. It's on lower time frame, but on this daily time frame, it is a fair value gap. So we can see here that price will want to close this fair value gap, and also we have a daily bullish order block below that over here. So that is a bullish order block sitting over here. And if we look, there was a reason why price came here, and this imbalance of price over here was basically being balanced. That is why USD CAD has been accumulating, compressing, consolidating in this zone for quite some time, because there was a large imbalance of price over here. And when price rallied up, it came down now into this zone, and that is why we are seeing it being traded so long in this zone after it rallying up and rallying down. Okay, so once we see that this liquidity pool is raided, we could potentially look for a buy over here for price to go up, because we also know that there's large liquidity voids that have not been filled over here when price came back down. So that one was filled. So there was at least two that have not been filled for now. Okay, so we would want to see price come back down into this zone, And once these gaps are filled over here and over here, this gap was pretty much filled to about 90% over here, okay? So that is why when this gap over here was filled, you can see to the pip almost, you can see the wick of that candle intersects with the wick of this candle, and then price drop over here. So when this liquidity void was filled, we had this order block filled or created, and that is when price pushed down over here. And this is where the sell came in, that this order block was being tested. And we know that when we see liquidity voids and fair value gaps, there is a large grouping of orders for the sell, because this is a also daily bearish order block over here, and the same as these green candles over here. These two green candles were completely traded through, so that makes us a daily bearish order block. So when price comes into these zones, price will fall, just like it did over here, testing this order block over here. Very small order block, but an order block nonetheless. And when it came up over here, we saw price fall from that zone, just like that. Okay, and again, this order block was created, like I first mentioned, this green candle was traded through. So this order block was created over here, and when price rallied again, it rallied up and fell because that is a bearish order block. At the same time, there is liquidity being engineered over here because they are creating equal lows. So if we see that USD CAD pushes up, then it is unlikely that they will raid this liquidity for now. But what essentially they could be doing is creating themselves a range for sell side and buy side liquidity. So here we have liquidity, and if USD CAD pushes up here but does not break this high over here, we have what retail traders see as a double top, and that would be a point of liquidity over here. So you can see that we have liquidity sitting below and liquidity sitting up top, and banks will raid the liquidity, as we know. Long explanation, but that's the quickest I can. Okay, baby trader, you asked me how can you trade intraday. So the same process can be done on lower time frames as opposed to higher time frames like the 4 hours. So you asked me how we can trade the order flow intraday. So let's look at EU. And if we look at EU, we have followed the order flow from all the way to the bottom, and we notice that it is bullish. Okay, so what we do, if we are looking for ourselves a day entry, we will like to go to a higher time frame to spot ourselves a strong bullish or bearish order block. Okay, so when, let's just, this price is a bit choppy over here, but essentially what you want to look for is when price dramatically thrusts up or thrusts down, that is a strong order block. So if you followed the order flow up here, this would have been an order block that would have been strong. The reason why it was strong is because it was able to take out these highs over here. So this order block was strong and these highs were taken. So this is a bullish order block. So we've marked this up on a higher time frame. So let's just make that red. Now this is a 4-hour time frame. So when price intersects on the 4-hour time frame or the lower time frames, we will want to buy because this is a strong bullish order block. So our movement or our position of our trade, we will want to look for a buy. So then we go drop down to a 1 hour and let's go look at that same area of price. So now we see on the lower time frames, that we have other reasons once the order block is created for price to retrace downwards. What are those confirmations? So here we see that this was a fair value gap when price rallied up. This was a fair value gap. And if we pull that across over here, we can see almost to the pip, these candle bodies filled this fair value gap and bounced off of this order block. So if you know anything about other time frames, these two bearish order blocks sitting over here, I'm just going to make them pink over here. So these two bearish order blocks were then traded through over here, which creates ourselves the 4-hour order block we have highlighted in red. Okay, so when it was traded through, these two black or bearish candles were traded through by these 3 green candles over here. Sorry, let me just delete that. So these 3 green candles over here, 1, 2, 3. This is an order block. Okay, so price rallied up and retraced, and when it retraced, it tested this order block over here. Price rallied up, closed this fair value gap over here, and you can see it testing this order block. So another order block was created on the 1 hour over here inside of our 4-hour order block. So the 4-hour order block is created, and inside the 4-hour order block we have other order blocks on lower time frames that have been ordered or created, sorry. And when price comes back down to fill this fair value over here, price tests our 4-hour order block and tests our 1-hour order block. So this can be an intraday setup for you where you just mark up one bearish or one bullish order block, and then you go down to a lower time frame. You can even do this on a 1 hour to a 15-minute. In this example, I'm doing H4, 4-hour chart to a 1-hour chart. So you just use 1 hour, 30-minute, 15-minute if you want to trade off a 1 hour. If you want to trade off a daily and a 4-hour, that's fine too. The principles and the concepts remain the same. Fair value gaps, liquidity voids, IPLs. And if we add an IPL over here, pretty sure we would have our 200 level sitting over there, and above here we would have our 500 IPL sitting over here. So now we have, just by adding a few things onto our chart, multiple confirmation to take a trade over here. So let's add another confirmation. So this is a 1 hour chart, body to body. So recent low would be here, because this is our order block and price rallied away from this zone over here. So this is the order block where we pull our fibs from, because we are looking to go bullish. This order block is bullish, so we are looking to go bullish. So we pull a fibs from the bodies on this 1 hour to the bodies of the highest order block, or wicks, sorry, not the wicks, the bodies. And that doesn't necessarily have to be an order block, by the way. This was an order block, so this is where we pull from and where the retracement started. And you can see here that our sweet spot is being touched. 62%, 75, 70.5%, 79%. OTE was touched, entry taken. There you go, there's your intraday, 118 pips. Hopefully that helps you. Baby trader, does that help you?
Yes, it did.
Okay, and the same thing I just showed you on a 4 hour, you can go to a 1 hour and do it on the 1 hour, the 15 minutes. The same applies. You look for order blocks, you give yourself confirmation, and then you take your trade. Okay, so question from Sham. Hi Darren, how do we recognize a reversal on gold after it has taken out the daily liquidity? Please do explain. Okay, so I'm going to add the daily highs, daily lows, and I'm going to go down to a 1 hour chart. So how do we recognize once liquidity for the previous day has been raided? Okay, so we're going to need to find a day where liquidity is sitting. So let's mark up this low, and we know that that was taken over here by this area. So let's just highlight this area, and price rallied from here because it had taken out the previous day's low, okay, and then price rallied. But Sham wants to know, how do we know that this is going to happen? What confirmation do we have over here? Okay, so let's look at a lower time frame on the same area of where price rallied from. So the purpose of trading the liquidity on gold is not to catch the bottom wick of the move and then take you into the trade. You want to have confirmation that price is showing willingness to go up. Okay, so the willingness to go up here, once the low has been raided over here, is the fact that these large move to the upside over here. So this is a 15-minute chart. So this candle represents 15, 30, 45 minutes of bullishness, showing willingness to go up instead of willingness to go down. So essentially what we can do is, once the low for the day or yesterday's low has been taken, we can look to buy around that zone. So we can even go onto the 5-minute chart and look at that area. When price intersects with yesterday's low, this red line over here, we want to see reaction off here. If we don't see reaction, we don't trade. So we want to buy once yesterday's low was taken. So here we have a perfect retail setup where we see that this little head and shoulders, like they like to call it, is formed over here. But essentially, we don't look for that over here. What we look for is, once the low has been raided, we want to look for a buy. And how do we recognize a reversal? So, like I said, when price pushes below that low, we want to see the price stop pushing lower than once it had raided that low. So we want to see a reversal in essence. So how we see that reversal is, instead of the candles going down, the candles must go up on the lower time frame, because they have raided the liquidity. And this raid on liquidity can last from anything, especially on gold, from 20 pips to 50 pips. It's up to the market makers to decide how much they want to raid, and we want to see that reversal happen. So we can even go and pull our fibs on the 5-minute chart like we do, body to body, and wait for ourselves for an entry over here. So when we see this large move to the upside, we have a 62% retracement over here. Okay, so now we have price willing to go up over here, and we can see that these highs are being increased. It is taking out other market structure over here, so it is showing willingness to go up. So that no longer becomes where we pull our fibs from. Instead, it comes to this area over here, because that was the low of where price traded to once it rallied from the taking the liquidity of the previous low of the day. So it raided it, ran up, retraced, ran up again, breaking market structure, showing willingness to go up. So we are looking, if we miss the buy opportunity over here, we are looking for another buy opportunity. And as we can see, price rallied from that retracement into its next retracement, which would have been the OTE on the 5-minute chart over here. And you could have been taken into the trade from there with very little drawdown, based on the fact that the low or the liquidity of the previous day or previous days or the previous weeks was taken. And you need to see this reaction occurring over here. I will create a video of how to add additional confirmation to an order block or multiple order blocks, or every concept I've shown you, an additional confirmation of how to look for price reversal at a specific zone. It is beyond the scope of this Zoom call right now, and it would take too long to explain, so I will need to make a separate YouTube video, but it is actually quite an essential YouTube video because it will explain why we should buy at the zone we should buy at. Okay, Sham, that's a very long explanation. I apologize.
Thank you, Darren.
Okay, so USD ZAR, someone asked me. Okay, so I was looking at a zone to potentially look for a buy over here. And the reason for that was it is counter trend. So if we look at the daily chart, obviously UZAR is bearish. That's on a trend line. That's just direction. So price is bearish, as we know, and you can see that the bearish order blocks are being created and price is falling over here. So potential reversal or counter trend, if you will, would have been at this zone over here where there was an order block, and if we zoom in, there was a fair value gap I had marked. Well, not marked now, but it had been marked that there was a fair value gap on the daily chart over here, daily bullish order block. And when price had closed this area, the 4-hour also indicated to us that at that zone, there was also this fair value gap over here inside the daily order block. So we would expect price to close, and it did, at that zone. And obviously it is testing the daily order block we are seeing over here, and we have seen a bounce off of that zone over there. I had this black line over here was where I wanted price to go to, but it didn't quite get there. But it did close the 4-hour gaps that were present, as well as bounce off of that previous daily order block. And we see a large move to the upside. And yes, I do sometimes trade USD ZAR only as an exotic pair. I don't trade other exotic pairs, but that's my personal preference. There's nothing stopping anyone else from trading any exotic pair. Generally, exotics have higher spreads if you don't have an ECN broker, but they are fair game and quite volatile, so I would recommend you use a daily and a 4-hour. And if you are wanting to scalp, well, that's your prerogative, but market close generally brings high spread, and they don't like to always fill the gaps that they create, but generally they do, not always. But you should go and back test it on other pairs, but USD ZAR is a good pair to trade. I trade it personally, so I'll definitely look at that, whereas USD MXN, your home country, Alex, so I don't trade the peso, so that's up to you if you want to, but I guess you could see the same setups we see on other time frames for other gold and whatever else we look at, so the same rules would apply there. Okay, Liago, so this is a question I get a lot, and if you look here, that this is the dollar index. Let me just put the same over here on the 4-hour and the 4-hour. Essentially what you look at is a mirror image of Euro USD. So this is the daily chart for Euro USD, and this is the daily chart for the US dollar index. So this long trend to the downside, this trend to the upside, and this long move to the downside. So down, up, down is in reverse to what is happening on Euro USD. So up, down, up. So you can see in reverse essentially what I'm showing you here, that when the one is bullish, the other one will generally be bearish, and this will be 80 to 85% of the time correct. So you can use the DXY or the US dollar, depending on whatever your broker calls it, to base your trades on that. So the same can be said for this pair here, which is USD CHF. A lot of people also use this as a confirmation. The similar rule would apply for that purpose. When the USD CHF trades down, the dollar is bearish, same as what the dollar index tells you, it is bearish. So generally the USD will be weaker and other pairs will be stronger, as we can see here. So when Euro USD goes up, the dollar index goes down, and the same would apply for USD CAD, NZD USD, GBP USD. Any USD pair generally is linked to it, and you can take trades based off the DXY slash the US dollar index, but that would only give you a divergence way to indicate your trades. So when the one does a buy, the other one will generally do a sell, and that is how it is taught. That's not something I really cover because it's, the one goes up, the one goes down. It's not rocket science. It's pretty straightforward. Nothing really to teach there. There is, however, SMT divergence, which is something different, and that will be shown also later on. And let's see if there's any other questions. Anyone else got a question on Zoom? It's been...
Hi, Darren.
Manana, yes, hello.
Yes, my question is, let's say you are someone who's very busy and you want to put in a trade and maybe let it hold for a few days. So I've seen in most of your videos, you recommend 30 pips stop loss. Would you still recommend us to do that when we're trading the higher time frames, just to be able to hold the trade for longer?
No, not at all. So when everyone starts here, I don't recommend using a 30 pip stop loss, and I don't always use a 30 pip stop loss. The market decides to us what stop loss we can potentially use. And obviously, the smaller the stop loss we can use, the higher the risk reward ratio we will have, because we can use percentage-based trading. So if you see where the order blocks are, where the reason to take your entry, whether it's for a buy or for a sell, the market should tell you where you would take your stop loss to. And you should have a limit as to where you want to set your stop loss. So whatever your account size is, depending on how you trade, if it's swing or intraday or scalp, generally your stop loss would be higher if you intraday or swing. But if you are scalping, well, then you have a very small stop loss. So I'm assuming that you're wanting to swing or day trade during the week. And if you want to do that, you can take a stop loss of 50 pips or even more. The aim of the game is to obviously not lose money. So again, put a stop loss at a comfortable position, but at the same time, if you have a stop loss too big and you are using a stop loss and you're using percentage-based trading, well, then your lot size is going to be very small. So you're going to have to want to catch a large amount of pips. Now that can work, but then we're talking, 500 plus pips a week, which is fine. That's fine. That's not a problem. But then you have to make more trades, and that's fine too. You can do that also. But if you want to take less trades, talking like maybe 5 trades a week, then you want to have a smaller stop loss because you are trading less, but your lot size is higher because you have a smaller stop loss. So where do you put your stop loss? Good question. So USD CAD. Okay, this was a trade I looked at, so this is why I'll use this particular example. And let's just clean up some of this here. Wanda, you still following, right?
Yes, I am.
Okay, so if you look here, that you asked me where to place a stop loss. Okay, so here was a trade I looked at and that I traded. So here we have a daily bearish order block. Okay, so when price came into this zone, I said that price will likely fall again, and that is why I wanted to sell. So I also noted that this was a fair value gap that was unfilled on the daily chart. Okay, so I wanted to sell once this fair value gap had been closed. Okay, so I wouldn't just trade off a daily. I've marked it out on the daily, and now I want to swing this, for example, like you potentially would have wanted to. Okay, so how do we place our stop loss? Okay, so now we notice that we have our IPLs at these zones, which is our 500 level over here, and our next IPL above here is our 800 IPL over here, and I will add one more IPL, which is the one where price basically fell from, which was the 200 IPL over here, and I'll also add my fibs because that is where I sold from. So now we have a setup. Okay, now you ask me, where do I sell from, or where do I place my stop loss? Okay, so we see here that price rejected at the 500 IPL over here and failed to close above. Okay, we also have our daily gap filled over here. So if we had, for example, sold at the 500 IPL, we would have not been entered into the trade. Okay, so let's say, example, you had set a sell limit at the 79% retracement, and you had set one at the OTE retracement. Okay, so those would have been your two sell limits that you had. One would have activated, and if you had put 30 pips, let's see here, 30 pips, you would still have been in the trade. Now, generally, that's a decent trade, okay? But if you see that there is other IPLs, okay, and they are being respected, you want to use those IPLs for price to not close or go above those IPLs. So if we want to sell USD CAD and we see wick rejection, the close of this candle and the open of this candle on this red vertical line would have been the candle that you had taken the trade on, okay? And you could have entered on this candle and placed your stop loss above this 500 IPL. So generally, I do the same. I generally use nearby IPLs for a stop loss or a nearby order block or a fair value gap that had closed. There's just the same reasoning you would take a trade to enter it, the same reason you can use to place a stop loss. So, for example, these highs over here had liquidity above here. So there was liquidity there, and price rallied through that, taking out that liquidity. Okay, that's all the point of that move, was to take out this liquidity and close this fair value gap. So that liquidity had been raided, and this fair value gap on the daily chart was closed with this move to the upside. Then price failed and did what it needed to do. Didn't need to go any higher. So you could have even put your stop loss above this high over here, because it had served the purpose of running out the liquidity on these highs over here. So these were obviously highs, and when it was raided over here, price came through there, raided those highs. We had reason to sell, and you could have put your stop loss just above that high, or even at the IPL over here. And if you had sold on the next candle, well, there you go. There's your 30 pips. Sure, you don't always get a scenario like that, but in this scenario, that 30 pip rule applied. Now, I normally illustrate to everyone starting out here that they should try starting with 50 and work their way down to 30 and less than 30. So I don't like to use higher than even a 50 or a 60 to teach people, and that should be your starting point and work your way down. So obviously, if you put too much of a tight stop loss, it will be hit. And if you don't know what you're doing, well, then you're going to take a lot of losses. So that's why we trade on demo and we understand these concepts, and then we move over to a live environment. So, Wendy, was that helpful at all to know where to place a stop loss?
Yes, yes, it was. Thanks.
Okay, great. Anyone else got any questions? See, there's a lot of people here now. Okay, I'm just reading on the Telegram chat if there's any questions here.
Okay, Darren, sorry, I have a question.
Yeah, sure. Go ahead.
Okay, can we get back to gold?
Yeah, sure.
Okay. Can we say that can we say at the moment the gold is ranging, but move to the upside or to the downside? And what's the possibility of it going higher, or the possibility that it's ranging for it to break lower? Because at the moment it looks like it's ranging.
Were you here in the beginning of the Zoom call?
Okay. No, maybe I have to watch the video.
Yeah, we already did everything on gold, like everything you just asked is covered in the very start of the Zoom call. So if you go watch
Okay.
when I upload it to YouTube, you'll see all of what I said about gold. That will hopefully answer your question.
Thank you.
Darren, Sean.
Yes, Sean, yes.
Hi. Darren, I have a question. I was just going through your audio file that you had posted a couple of hours ago.
Yes.
That says that how the algorithm changes if it's bullish or bearish. About the blue line and the red line.
Okay, well, this extends beyond the scope. Otherwise, I would have to cover too much content in one Zoom call, so I'd have to leave that for another time.
Okay, cool.
I have so many questions here that people are asking me.
Sure. We'll do it at the next call.
Okay, baby trader, I think I answered your question of how we change the order flow. I answered your question about DXY structure because we use the DXY to see the opposite or mirror effect of USD pairs. USDs are, please stop doing that on my screen. And let's see if there's other questions here. You can raise your hand or ask in Zoom if you have a question.
Hello, Darwin.
Yes, hello, go ahead.
Yeah, this is Charles. So I would like to ask, using is FBS trading systems, is it okay?
Yes, that's fine. You don't. That's something you can.
Are they liquidity? Okay.
That's something you can ask on the Telegram group.
Okay.
We do charting here on Zoom, but yes,
okay.
it is a good broker, and a lot of people do use it. But there's always going to be review sites. There's always going to be bad reviews. There's always going to be good reviews. I'll post another link on the Telegram where you can go decide yourself, because I swear by liquidity providers that provide liquidity to brokers, and brokers get liquidity from liquidity providers, and these liquidity providers are the market makers, the banks, the institutions, Bank of England, Bank of Australia, Bank of America. These are the liquidity providers, and they provide liquidity to brokers as we use as the retail traders. So these liquidity providers are important to your broker, and if you have a broker that uses decent liquidity providers, then you have a good broker. and I'll post that link in the Telegram again because it is quite important if you want a good broker. And if your broker does not disclose liquidity providers, then they could be manipulating price and spreads can be higher. So that is something to look out for. Savage, are you in this Zoom call? I see you asked a question about order blocks. So we are getting towards the end of this call because it has been very long and I need to wrap it up, otherwise people will fall asleep. So, Junior, you have a question. Junior Andre.
Yeah, like I would like to know on which time frame is the fee very effective, and also can I check out EG4?
Sorry, you'd like to know about a higher time frame. What was the question?
I would like to know on which time frame the fee is very effective.
Which time frame is trading very effective?
No. Like on which time frame is the Fibonacci retracement very effective?
All of the time frames. It depends
Oh, okay.
on you when you are willing to take trades. So let's look here. Let's look at Euro USD quickly. So let's look on the 4-hour time frame. Let's look. So when we pull our fibs from the recent low over here, so this is the recent low of those bodies to the recent high, we want to look for a buy. So we pull our fibs from the body to the body, and we can see here it takes us into our sweet spot over here, and you can see that the wicks are just closing below, but the bodies are contained in our sweet spot. So this is a 4-hour chart, and that is fine to trade on, and the same can be said if we want to look for a sell on the 4-hour chart. Here we have highs over here. Here we have the lowest low before a retracement started. So we pull our fibs bearish. And when we pull bearish, here is our sweet spot. We have an entry. So this is how you would look for a fib entry, and you can use any time frame. This is the 4-hour. Now let's go down to the 1-hour time frame and look at recent price action. So here is recent price action. We have these highs over here. We have this recent low over here, and we pull our fibs from that high to that low over there, and you can see that price traded above our 79% over here. And what do we have here? If we add ourselves the 200 IPL, sorry, that's not the 200 IPL over here, 500 IPL over here. Price is trading inside this range. So now we pull our fibs from this high to this high. Also know that this would have been a 1-hour order block inside here. So there is reason to sell, even though it came above our 79%. The fibs alone, like I keep saying, is not enough to give you entries if you are trading on higher time frames. The lower time frames can be used for fibs if you want to only use fibs. I know a lot of you only want to use fibs. So for that reason, let's go down to the 15-minute, because you all love to use fibs and only trade off fibs for some reason. So when price rallies, here is where it rallied from, here is where it rallied to, and this is where price retraced to when it started retracing. So you pull your fibs because it is showing willingness to go higher. You pull from body to body, and we have a 62% bounce. There we have a 15-minute buy on Euro USD. Now, there would have been other confirmations if you were looking, but we all like to trade just using fibs apparently. So here would have been a bullish order block maybe, or a fair value gap that would have been closed, and you are pulling bullish fibs. Okay, so this example, pretend we have other confirmations, but we don't. So we are pulling fibs bearish, sorry, bullish, and price is coming into our 62%, and we are selling. So let's look. Do we get another entry somewhere? So here we have a low over here. Here we have a high over here. Here we want to expect bearish movement. So we pull our fibs. We don't get an entry over here. See, you don't always get an entry with fibs. But if we go look, price is moving lower over here. So this order block and this market structure over here was broken. Over here, this market structure was broken. You can see price traded through that zone and formed these lows over here. So now we pull our fibs from the order block that broke market structure. So when we do that, we pull fibs from the bodies to the bodies, and we have a sweet spot entry, just like that over there. And these are the types of trades you can take with fibs. Higher time frame is obviously confirmation, and lower time frame can give you entry on its own. So again here we have ourselves a high and we have ourselves a low over here. Then price started to trade into a retracement. So price fell, price retraced. Where did it retrace to? Sweet spot. Sweet spot over here. 79%, 70.5%, 62% retracement. Price then fell. Okay, so at this zone, there might have been a 4-hour order block or a 1-hour order block or a fair value gap that was closed. This gives you confirmation to sell. Okay, so fibs alone, if you are not using low time frames, won't always give you entry, but fibs should be used as additional entry confirmation and not traded by itself, because it is not always 100% accurate. When you have additional confirmations, that is more accurate. But you can, as I'm showing you here, trade lower time frames with just fibs. Here we have market structure, and this market structure was broken. Okay, as you can see, it was traded through. So this order block was the order block responsible for breaking this market structure over here. And this is where price started retracing from. So now we pull our fibs over here, and you can see, even though we have a wick, the bodies are inside of our sweet spot over here. There's our sweet spot. Price falls. Well, market structure was broken. This order block was responsible for that. So that is why we pull from this order block to where retracement starts, and that is where our entry comes. But we need to know which way to pull fibs, or we're just going to get random entries. So we need to have directional bias using the order flow, using order blocks, other confirmations. Okay, so hopefully that answers everyone's questions about fibs and which time frame is the best. There's no best time frame. It's up to you to decide how you want to trade. No, I'm sorry, I do not use TradingView. I've used MetaTrader for 7 years, so I'm not learning to use TradingView, which has only been around for a short amount of time, as opposed to me learning MetaTrader. There's no point in moving because it's the same thing. I don't want to use TradingView, and then I must go to MetaTrader to execute my trades. So personal preference, I don't use TradingView. I prefer MetaTrader, you prefer TradingView, that's fine, but I don't use TradingView. And if you have any more questions, you can always email me and we can cover them in another video. But this video has been quite long and hopefully I've answered a lot of questions here. It wasn't meant to be so long, but there was a lot of questions, so I had a lot of answers. And sometimes my answers are very long and I apologize, but I need to explain things in a very granular form for most people that are learning here. So we're not all on the same level. Some know more than others, others know less than some. So for that reason, I have long explanations. So you'll always get more than you bargain for. And use it, don't use it. Hope you enjoyed the call on this particular Zoom, but we're going to have
Thank you very much, Darwin.
wrap it up now.
Thanks for the lesson, Darwin.